What's going on, guys? Jason here back with another video, and today we're going to be talking about how people are struggling with some hidden fees that come along with homeownership. And I have a lot of experience with this. One of the things I always talk about, people compare renting versus buying. They're like, well, rent costs just as much or maybe a little more than buying a home would cost me to pay the mortgage. But they don't realize that a lot of times there are a lot of fees that come along with homeownership that totally obliterates that, not to mention all the interest that you're paying in it. But first, I have a quick favor to ask you. If this is your second time or more tuning into one of my videos and you get any type of enjoyment from it, please feel free to give it a like and to subscribe if you feel so too inclined, because it does help with the YouTube algorithm, and I will greatly appreciate it. And with that, let's get into the video.
Record high inflation may have people questioning whether homeownership is a good investment. Property taxes on the median single-family home have risen by more than 25% between 2019 and 2023. There's also been about a 20% increase in home insurance premiums between 2021 and 2023, according to insurance comparison company Insurify. Insurify estimates rates will rise another 6% by the end of 2024.
What many have failed to anticipate is the
Really quickly, that's a very important point, because a lot of times the value of home ownership is that once you pay off that mortgage, you only have to pay for your property taxes and your insurance, and then you also should pay for maintenance and repairs. But if you're going to continue to see increases in insurance costs and increases in property taxes as values of properties keep going up, eventually it's going to start to equal out to where you might be paying $1,500 a month between, which sounds crazy, insurance and property taxes, where your rent might be $2,000. It's like, well, shoot, I just paid 30 years or 15 years on a mortgage. I might as well go on rent instead of getting this 30-year mortgage, is what I'm trying to say. So, I mean, it's crazy.
rise in both property taxes, and that's correlated to the rise in the value of their home, something that at some level helps them, as well as the increased cost of paying for that insurance.
82% of recent homebuyers said they regret their purchase, with 44% saying they've had to take on additional debt to maintain their standard of living.
Just because a person may own a valuable home doesn't necessarily mean that they're financially set. There are other costs associated to maintaining that property.
Unfortunately, a lot of people go into buying a home and they don't understand that their monthly payment could change.
More than 1 in 4 homeowners with mortgages spent more than 30% of their income on housing costs, implying they're cost burdened. Here's why home payments are skyrocketing and how people shopping for a home can prepare.
Homeownership is the primary path toward wealth creation in the United States.
Single-family homeowners accumulate an average of $225,000 in wealth from their homes during a 10-year period.
These stats really drive me crazy. See that $225,000 they have on the screen right now? How much of that can you take and go buy some chicken or buy some groceries or go buy some Chipotle or go pay for an oil change or go see a movie or go pay for your kids' childcare? Well, actually, you know what? You can, but you know how you do it? By accessing your equity in your house. You know how you do that? Either you get a credit card on your house, which is called a home equity line of credit. I call it a credit card on your house. Or you refinance and you pull the cash out, the equity, this $225. What happens then? Your monthly payment goes up. You pay interest on that. Your amortization schedule starts over. If you ever seen an amortization schedule, first of all, brace yourself, because if you look at it, the first 15 years, you're paying mostly everything towards interest. The bank wants to get their money first. So the first 15 or plus years, depending on interest rate and how expensive your house is, if you're making the minimum monthly payments with a 30-year fixed rate mortgage, which most people get, you're going to be paying a little more than 80% towards interest only, not towards the principal in your property. So when they say it's a way to build wealth, by the way, once you build that wealth over 30 years, what happens then? Typically, your homes get sold by your kids because they don't want it, or your kids don't want to take on the property taxes. It's not all it's made out to be. So it's a smart way to buy and a not smart way to buy. Maybe they're going to get to that. We'll see.
According to a 2022 report from the National Association of Realtors.
That wealth sort of boils down to being primarily only on paper, and the time that you cash in that asset is when you sell the home.
There's a saying, house rich, cash poor, meaning people may own a valuable home, but that doesn't always translate into having cash on hand.
Home prices have been increasing over the last few years, and it's outpaced income for the average consumer. That's a problem because that creates an affordability crisis for the average person.
This can be a problem because as the value of a home rises, so does the cost to maintain it. Property taxes are one of the costs that can increase with the value of the home. Homeowners whose properties were reassessed between 2019 and 2023 amid skyrocketing valuations saw an increase in taxes. The median taxes for properties that were reassessed increased more than $600 for the year between 2019 and 2023.
Local municipalities can do these. Each local government has a different form of them in certain areas where they go, we're going to do an assessment because we need to build some new infrastructure for something. And this is how we're going to raise the funds for it. And so that's another important thing with your realtor is to talk about, has the town and county been talking about any sort of assessment like this coming up? Have you heard anything? If your realtor says, I don't know, then go get a new realtor right away because they should be following all this stuff because they are your advocate and they're your guide.
Tax increases in the past 4 years varied by state, with New Jersey, Connecticut, and New York seeing the highest average property tax increases, while West Virginia, Alabama, Arkansas, and Mississippi saw the lowest.
So fun fact, so whenever you're going to buy a house, at least in the area I'm in, the assessment is done on the real estate every 3 years. So if you're going to buy a house and it's right before that assessment is going to be made, make sure you pay attention to that because what you see from that estimate is going to change drastically very soon because they may have assessed the house back in 2022, let's say, and they assessed it at $300,000. And now let's say it's 3 years down the line, it's now 2020, what, 2025. So this year is due to come back up to be reassessed again. And let's say property values have gone up, which they have. Now, when they come reassess the property, they're going to say maybe it's worth $350,000, $400,000. Now the amount you're paying in taxes is on $100,000 higher value in this example. And so once you got that mortgage estimate to see how much you're going to pay each month in your mortgage, principal, interest, taxes, insurance, it was taking into account the property taxes from the prior years, the prior times assessment. So it's going to increase already just off of that. So people hear 30-year fixed rate mortgage, they're like, okay, this is all I'm going to pay. 30 years fixed rate, this is what it's going to cost me. HOA or condo fees can go up. Interest can go, or insurance can go up. That's another thing. Insurance companies, they can raise their rates for no, just because, well, a lot of times they do it for good reason. Cost to replace the house if it burns down has gone up. So that goes up. Not to mention if you need to do repairs and maintenance, which is another thing people don't necessarily factor into the cost of their house. They're like, okay, principal, interest, taxes, insurance. Well, if you have an apartment or you rent, the landlord pays for the maintenance. If you buy, you pay for it. If materials go up and the cost for that labor goes up, you have to have something fixed or replaced, like a water heater or a roof, or if you want to make some cosmetic changes in your house, it's going to cost more than it did 3-4 years ago. All things to keep in mind.
Homeowners insurance is the other major expense that can fluctuate after a home purchase. The average annual homeowners insurance rates in the U.S. increased from $1,984 in 2021 to $2,377 in 2023. One estimate from Insurify predicts average annual rates will rise to roughly $2,500 by the end of 2024.
In the last couple of years, we've seen this spike, this huge increase, and it is because we are having more natural disasters in places. We're having more wildfires, we're having more flooding, we're having more mass destruction events, and those have to be recouped by insurance companies somehow.
With the increase of hazardous weather, lots of major insurers are leaving areas, and it's not limited to California and Florida anymore. Like we're seeing that in Colorado and like other areas where wildfires, tornadoes are common.
Those states are seeing the biggest spike in insurance rates, with Florida leading the pack. The average annual rate for insurance in Florida was nearly $11,000 in 2023, which is more than $8,600 than the U.S. average. Florida cities make up 6 of the top 10 most expensive to insure in the country.
There are some states that actually have legislation in place that insurance companies can't raise your premiums more than a certain percentage each year.
Insurance is a highly regulated and complex market, but going without it is not an option for many homeowners.
Homeowners insurance is a necessity for people, particularly those who have a mortgage, because if anything happens to the house, we need to be able to recover the cost of the damage to the home, particularly if it is destroyed. You need to either do the repair.
Yeah, depending on the type of loan product you get, you have to have a insurance. And I would advise to have it anyways. But let's say you get an FHA loan, which is a Federal Housing Administration loan. That's the loan you might have heard of where you can get like a 3.5% interest rate on it. It's for first-time home buyers. And the way they do it is it's a special loan product. You have to have escrow with the lender, meaning it has an account set aside where they collect money each time you pay to your mortgage for insurance and for taxes. And so they force you to have insurance on your property. So for most people, matter of fact, any lender, even if it's a conventional loan, they're going to force you to have insurance. And again, I think it's a good thing. So you might say, well, I'll just save up money for myself. And if something happens, something happens. But most people can't afford it, which is why the insurance exists in the first place. But I mean, like I said, a lot of people are saying like, okay, these insurance companies are greedy, but the reality is a lot of them, okay, I'm not going to say that they're not greedy. Maybe they are, but a lot of them are just trying to recoup the cost from paying out all these different claims, especially if you live in some of these high impacted areas, as they mentioned, Florida, California, as we know right now, is going through wildfires. So Hawaii, other places with natural disasters, tornadoes, mudslides. I mean, I don't know. Now, are these things really increasing? I don't know, but nonetheless, one thing that is increasing is the cost of your insurance.
The cost of repairing a home has risen, which affects insurance premiums.
Obviously, over time, you want to try to make sure that you have the right homeowner's insurance.
There are ways for prospective homeowners to set themselves up for success.
People who buy today with the assumption that they qualify based on the current real estate taxes or current insurance need to really do more homework to understand where they could really be in a year.
Homeowners should lean on their realtor first. And you need to look at things like how much your homeowner insurance is going to cost. Even trash removal, water bills, gas bills. How much did the electricity cost last year? Can I get a history of things like the electrical bills, things that we know we can go back and see? Does your state have any laws that my property taxes can only go up a certain amount each year? That's a great question to ask if you're relocating to another state. A realtor is really important to work with because they're going to be able to answer all those questions for you. You want to leave yourself a little bit of room. Just because you qualify for $3,000 a month in a mortgage payment doesn't mean you should max it out right now. Look for something where you can get in around $2,500 at $3,000 is your comfortable budget. Go a little lower than that so that you give yourself that room.
Current homeowners who are struggling to meet their monthly payments also have some options.
Start on your county assessor's website. They have a ton of resources generally. If you can't find what you need, ask your realtor because they should be able to point you in the right direction. There are resources available in most states for property tax relief. And so you just need to go and learn what those are, see what you might qualify for. But don't just assume I got to quit going out to eat. I got to cut all these other expenses. There might be a way for you to get some relief on your property taxes.
The Consumer Financial Protection Bureau, or CFPB, recommends reaching out to the Department of Housing and Urban Development to see if you qualify for any programs or additional help. The CFPB also suggests homeowners call their mortgage servicer to explain why they're unable to pay, whether it's a permanent or temporary situation, and details about their income and expenses. A mortgage lender may be able to work out a repayment plan or provide a loan modification. Homeowners can also consider switching insurance companies if their rates get too high.
Interview everyone, interview a few lenders, interview a few realtors, interview a few insurance agents because they all have different things that they offer and you need to find what works best for you.
Okay, yeah, so definitely price shop. That's for sure. That's with everything. As a matter of fact, this is unrelated to mortgages, but back when I had student loans, I paid them off, thankfully. I refinanced my student loans. People didn't even know. I know people in my close circle who didn't even know you could refinance your student loans. They thought that the rate you had is the rate you're stuck with. So it's to me, it's like as consumers, we're not completely helpless. We do have means to find ways to lessen our financial burden. Now, calling your mortgage servicer, is that really going to help? Part of me doubts it. I kind of like scoff at that. I could be wrong. I've never done it because knock on wood, I never had to. Maybe they will give you a payment plan. Who knows? But nonetheless, the moral of the story is research, research, research. When you are buying, a lot of people say that your primary home is the biggest investment you're ever going to buy. I don't necessarily look at your primary residence as an investment, personally speaking. I think it's just a place where you raise a family and you create memories and you put a roof over your head that's more stable than renting. But as far as it being an investment, not so much. There are studies that show that actually your primary residence, it doesn't really beat inflation. It keeps pace with inflation. So it doesn't really appreciate all that much. Now, obviously, in the past 5 years, that's different since COVID. And depending on the part of the country and that country you're in might vary. But overall, it's not that much of an asset. And then again, if you take a look at the amortization table and you see how much interest you're paying over the life of that loan, you're paying more in interest than you paid for the principal of the house. You bought a house for less than $350,000, you get a fixed rate 30-year mortgage at today's interest rates, you're going to be paying, and you make minimum monthly payments. By the time you're done paying that mortgage off in 30 years, which most people are going to refinance or move before that time anyways, which defeats the purpose of buying, you're going to end up paying more than $650,000, $700,000 in interest, which is more than what you're paying for the purchase of the home itself. So do your research. Look at, like they said, look at the prior bills for utilities, for water, for trash removal. Look at the HOA and the condo association bylaws. Look at the last time the property was assessed for taxes. Look at any assessments that may be coming, which is like if they're doing street work, for example, or they're putting in new lights or doing something big in the community, that they're going to start pushing that cost off onto the homeowners, especially if you're in a condo association. That's a big one. And HOA as well, like townhouse, for example, or just an HOA place, which most houses are in now. More of the story is do your research, buy when you can afford, don't buy more than you can afford, live below your means, all these things. I don't want to preach. Um, just hope that you all make smart financial decisions when it comes to buying a property if you do that. With that being said, thank you for sticking around. I really appreciate it. If you found any value in the video at all, feel free to give it a like and to subscribe if you feel so too inclined. And until next time, make smart financial decisions.